the reason we were bullish on crypto at the start of this year and really for the last 10 years is that cryptocurrencies and blockchains do solve an important problem, which is how do you do trusted transactions between two untrusted parties? And that type of settlement and finality has been proven because, Bitcoin and Ethereum in their entire history has never recorded a fraudulent entry.
Something doesn't add up. Wall Street is pouring billions into blockchain. Bitcoin's network has never been more secure. Institutions continue accumulating. Yet crypto has spent months underperforming, while AI captures nearly all the headlines and investor money. So what is the market seeing that everyone else isn't? Tom Lee believes the answer has almost nothing to do with Bitcoin itself. He says the biggest force holding crypto back today isn't a broken market. It's a temporary shift in capital. And the moment that money begins rotating back, most investors may realize they completely misunderstood what was happening all along. But that's only part of the story, because he also believes Bitcoin could become one of the most important technologies in the age of artificial intelligence. And his prediction for what happens next could catch almost everyone completely off guard. Listen carefully to what he says next.
And that is why Wall Street is building tokenized assets and building stablecoin rails. And I think over time, using blockchain actually as a replacement for a lot of the legacy financial rails. For instance, there's a Goldman Sachs conference in Europe, in London today, and the number of attendees is actually almost tripled from a year ago. Similarly, I'm bullish on crypto because I think as agents and AI become a lot wealthier, and we're starting to see, agents create wealth for us and robots create wealth for us. To us, the opportunity is that we may be reaching a point where agents actually own more wealth than we do. And I'm going to call that the, quote, uncanny valley of wealth, that there may be a point in time where if our delegated agents make more money than us, we're going to wonder if we work for them or they work for us. And I think that is the reason why crypto and a lot of the technologists are starting to realize that crypto is really one of the ways for humans to control the future role of agents. So I think those two mega trends are still in place, but crypto prices have been absolutely terrible this year. I think part of it is macro. The monetary policy is not dovish. It looked dovish 6 months ago, right? Market was looking for 2 cuts. Now it's 2 hikes. That's a headwind. The Clarity Act, which was supposed to help provide and create federal preemption of cryptocurrency rules and let the CFTC essentially have purview over that industry, that's still stuck in the Congress processes. And AI, of course, has done so well that I think it's not only taken away attention, but it's actually taken away investor capital. So I think those are, to me, headwinds, but they're not creating what I call intermodal replacements. I think blockchain is still going to be central to the future of the financial services industry and actually to how we manage AI. Crypto is hyper volatile. So Bitcoin's fall from 120,000 to 58,000, and Ethereum, which is beta to Bitcoin, falling from 5,000 to 1,600. That's fall still within the historical parameters of the crypto bull and bear market cycles. So price hasn't moved to a level that would say anything's broken. But what has been broken is the fact that stocks have done well this year and crypto's done badly. And I think part of it is some of the macro things and that Scott and I discussed, like the Fed becoming a little more hawkish and AI really taking away some capital, and the Clarity Act and that the positive exemption that would come with it not happening just yet. But none of those really break the crypto story, because as a quote mousetrap, blockchain is still the best way to still transmit and store value and record transactions without trust. And that's why I think Wall Street is still going to build and is rapidly building on blockchains. It's just not happening to our everyday lives just yet. And for the same reason why I think a lot of the AI engineers are tinkering with using blockchain to manage future agents to protect us, because as AI becomes quite wealthy, humans might be taken out of that economic loop. So I think that's why, to me, Bitcoin will make a full recovery. I believe you're going to see Bitcoin over 100,000 by the end of the year, and Ethereum, back to over 5,000. So, I think investors' patience is clearly tested because I think Bitcoin's been down 3 quarters in a row. But I think it's never been down 4 quarters in a row. So this would be a test that if they don't bounce from June to September, then you're right, maybe something's broken.
Is there a price point at which you would say, yes, it is broken, the story is broken, and it won't work anymore? Like, do you ever think about that?
For Bitcoin, the way to look at it is its production cost, because there is a cost of mining and to find the next block. And I think Bitcoin is like 5% below production cost right now. If Bitcoin falls below 50% of production cost, it literally it means you just take down the network. You can't support managing the Bitcoin network with its current price. I mean, that to me, that would be the equivalent of like JP Morgan trading at half of book value.
What if the biggest threat to Bitcoin over the next few months isn't Bitcoin at all? Tom Lee believes the market is entering one of its most important stress tests yet. From a new Federal Reserve leadership that could completely change how markets interpret interest rates, to billions of dollars of private market liquidity expected to hit the system, to rising geopolitical tensions that could disrupt global energy markets, and record levels of market leverage that have historically preceded sharp corrections. Any one of these events could spark fear across stocks and crypto alike. But here's the twist. Tom Lee doesn't see these as reasons to abandon Bitcoin. He sees them as temporary tests of conviction. History shows that Bitcoin has often been shaken by macro uncertainty before emerging even stronger when liquidity returns and confidence recovers. So what exactly is Tom Lee watching, and why does he believe patient investors could be rewarded? Listen carefully to what he says next.
June to December, I think a lot of tests the market has to pass are going to be coming. The first, most obvious, is we have a new Fed chair. And Kevin Warsh has some ambitious goals. He wants to essentially reconfigure how the Fed functions. And he has 5 task forces. One of those is redefining inflation. The second is analyzing communications. The third is, how they collect data. And there's others. But to me, that is all new challenges for the market to understand, because they are very used to a cadence of press conferences. Prior to Powell, though, a press conference after FOMC rate decision was not the norm. And it sounds like Kevin Warsh might only do it when he has something to say. He also doesn't want to provide forward guidance any longer. So markets have to find a proxy for forward guidance. It may end up being prediction markets. And then he may want to redefine inflation, but that's going to be tough when he himself wants to keep inflation at, to get to 2% first, but then 2% inflation on what measurement? The second challenge is going to be the unlocking of all the IPO liquidity. So for SpaceX, that really starts in the fall. The third is this war with Iran is creating a cumulative and growing deficit with petroleum products because the Strait of Hormuz isn't back to normal. And even though gasoline is plentiful in America, it doesn't mean like lubricants and other petroleum products are plentiful everywhere else. And I mean, I'm being literal, but like it's oil that greases the machine, right? Like, is there going to be problems somewhere? Like, I don't know. I think it's highly uncertain. And the fourth is the margin debt is usually associated with some sort of correction in the next 6 months. So I think between now and midterms, there might be a fifth risk that emerges, or the fragility that we talked about that helps drive that drawdown. And, as you know, corrections, once they start, they can be very, very ugly. So I don't really know. And I wouldn't want to call it top either. So we've been advising our clients to stay invested, and we're still constructive because I think there's enough skepticism now. But even from that, whatever level we peak at, I think it's a big drawdown.
See it.
Whenever there has been a severe correction in the U.S. market, our stance has been that these would be V-shaped recoveries, and it's always been met with a lot of skepticism. Even earlier this year, we had said that the pullback associated with the war would be a V-shaped recovery.
You did say that, yeah.
Yeah, and many don't believe it because they would point to oil and all these uncertainties. But I think what I've realized is markets front load negative shocks. So that's why I think we could have a very severe correction. But unless the economy is breaking, so we actually have a negative cycle, I think that, and the yield curve will tell us, and spreads will tell us, corporate credit spreads. But as long as the economy isn't breaking, whatever correction we have will be V-shaped. And I know I'm saying something that sounds mechanical, but, and of course, it'll be put to the test, but that would still be my default belief.
When you think about your investment philosophy, you're kind of bullish by nature. Like, you think about what could happen in the future, how things could change in the right ways, what robots could do, what agents could do. And it's a great, I think it's a great way to think about investing. How do you stay so bullish? What is your investment philosophy that drives your views at this point?
One of the things that I learned from my earliest days on Wall Street, because this is my 35th year as a research analyst, is that I think that there is something unique about U.S. innovation. I think that the U.S. structure of creating incentives for innovation and I think somewhat positive regulatory backdrop and the ability for companies to innovate and constantly innovate, and I think companies continue to innovate, is the reason I've been optimistic. I think COVID was a really good example of that. The whole world shut down, and around the world, many companies suddenly saw a collapse in earnings. But in the U.S., through a variety of measures, including government spending, S&P earnings actually grew. But it was a lot of good companies making good decisions too. So I think as long as that vitality and dynamism exists in America, then I think I can stay constructive. But you're right, a business cycle will end, and of course, innovation could end. If America becomes has what we call Dutch disease and no longer seeks to innovate, then another country will take the lead.